Good evening, and thank you, Stephanie. I think Jason has framed the way in really important principles that really have to govern the way that workers' retirement funds are managed. And it's very important to keep those in mind when having a discussion about inequality. Because if those principles aren't adhered to, effectively sort of anything goes. And workers are the losers when anything goes. Right? So basic conceptions of fiduciary duty and materiality ensure that workers' money is treated seriously as their money and ensure that there is a way in which fiduciaries, the people charged with managing that money, from the trustees down to the money managers, can be held accountable to some kind of standard so that we know when our money is being stolen. And if those principles aren't clear, then workers' retirement security is at great risk. All right? So that framework that Jason outlined for us, he talked about materiality, but the basic duties of loyalty and care that exist throughout that part of the world, which our two countries are both part of, where we are inheritors of the English common law, that structure is very important too as a starting point. What I want to do in my hopefully brief remarks, and Stephanie will ensure that they are, is to locate the conversation about inequality in that precise framework. And to understand why, if you understand more in a three-dimensional way, the economics of pension funds, and particularly large pension funds, you understand why this issue is actually so important. And not, I could go on for a long time in my role as policy director of the American labor movement about why inequality is so important from a perspective of workers' experience or the perspective of what makes for a stable democracy. But tonight it's really about the question of about its importance to people who manage workers' assets with a long-term perspective in mind. And let's keep in mind, that's what everybody does. Right? The fiduciary duty is a long-term duty. The question of what is in the interest of a high-frequency trader may be of great interest to the high-frequency trader and anybody in the political system they may have bribed, but it's not really important from the perspective of a workers' pension fund. Now, so why is this so important? Well, the first thing is, or maybe a better way, I don't want to presume the answer. Let's talk about the questions one should ask. All right, the first question is, what lens should a fiduciary be looking through here? Now, I would submit to you that a fiduciary who is charged, as Jason and I think his colleagues are charged with, picking stocks, obviously has to think about the question Jason asked, which is, what is the materiality of inequality to a particular stock or a particular bond, right? But if you are the fiduciary for the pension fund as a whole, you really have to ask that question across the portfolio, the entire portfolio of the fund. Mm-hmm. And for tonight, that is the way that we ought to be thinking about it. And when you do so, you've got to do so against the backdrop of something that's generally viewed as a pretty conservative piece of intellectual work, which is modern portfolio theory, and theories about the general efficiency of markets. Now, some of those theories have taken a bit of a beating, but the wisdom of Keynes's comment that in the long run, the long run efficiency of markets is not terribly relevant because in the long run we're all dead. And that what kind of matters is the short-run efficiency of markets within our lifetimes. Nonetheless, I think that it remains pretty solidly shown that if you are managing a very large pool of money, it's going to be very difficult for you to beat the market. Right? So a small pool of money managed by a very smart person may be able to beat the market. Although there's some real doubt about that. There's this kind of monkeys throwing darts kind of phenomenon. But some monkeys will hit the target. But a very large pension fund, an Ontario Public Employees or Teachers Fund, to take a Canadian example, the ABP, there's a trustee here from the very large Dutch fund, the ABP, I see my friend in the corner there, CalPERS in the United States. Funds like this, they really are going to have a hard time beating the market over the long run. And most of them recognize that by investing most of their assets in indexed or close to indexed assets that are very cheap. The reason why I go through all of this is that once you understand that, then you understand the point that we began this meeting with. It's so critical to pension fund performance. And that is, what does global growth look like? And if your fund is, for whatever reason, overweighted to your home country, what does your home country growth look like? And here we've had an intellectual revolution since the financial crisis, that pension fund fiduciaries, I think, are not sufficiently educated about. Right? That we lag a bit. And that intellectual revolution was alluded to by my colleagues on the panel, and that is the understanding in the IMF report on the impact of the top 20%'s income on GDP growth is a good marker for this, is the realization that contrary to what the sort of Washington consensus Thatcherite model of the 80s and 90s suggested, that there really is a rather low limit to the point at which inequality is good for growth, and that it pretty rapidly becomes bad for growth. Now, by the way, if you'd asked Keynes this 75, 80 years ago, he would have basically given you the same answer as to why that's true that people like Joe Stiglitz have offered and offered successfully in the last few years. And that is effectively that two reasons. One is that you have problems with aggregate demand when a handful of people have all the cookies, right? That they don't spend it and they don't invest it, and they don't invest in an economist sense. And then secondly, you've got problems of political economy. You've got problems of people using power to game the system, and that slows growth. So what that means is that pension funds have a fiduciary interest in the level of inequality in the global economy and in the national economy in which a given pension fund is overinvested in. So that a Canadian pension fund, I kind of assume, is a bit overinvested in Canada. What goes on here is then relevant. Although Canada is obviously more globally exposed than, say, than U.S. pension funds are, I suspect. So that's one. Right? And that is, again, it's not an issue for a stock picker. It's not an issue for an active money manager. It's an issue for the fiduciaries, the trustees, the asset owners, the people looking at the entire portfolio. It needs to be looked at, though, through the metrics that Jason was talking about, through materiality, through duty of care, duty of loyalty. It can't be pursued as an end in itself. It's got to be pursued by pension fiduciaries in the context of what is in the economic interest of the fund. Now, if you move from there to companies, to individual securities, then you've really got questions that, again, I want to highlight that my fellow panelists have raised, and Jason in particular. You've got two basic problems that you got to keep an eye on as a fiduciary when you look at individual companies and individual securities. And one of them I would call essentially the zero-sum game. That there are ways in which the managers of firms that you invest in, the people who actually control what happens behind the piece of paper that is the bond or the stock, their ability to take money from your pension fund. There are two different ways in which they can do that, and there may be more, but these are two basic ones. The first one is simply to take money. Right? In the United States, a typical CEO today is paid about approximately $12, $13 million a year. There are some CEOs who are making over $100 million a year. And there's not a lot of correlation between those individuals and long-term performance. That strongly suggests people are just like picking your pockets. Now, they're picking your pockets in a way that is adding significantly, both directly and indirectly, to overall levels of inequality in the society. But from the perspective of an active money manager like Jason, they're simply picking your pocket. That's why I believe one of the reasons why you mentioned CEO pay as a material issue, right? Because you're not getting what you're supposed to get as an investor if the manager is taking all the money. The second issue, though, the simple take, right, is something that you ought to be able to handle if you've got like a slide rule or an abacus, right? You ought to be able to figure out that your managers are stealing from you. But the second issue is really much more complicated, and that's the issue of incentives. And that was raised by several of my fellow panelists, and has really became very clear in the context of the financial crisis in the United States in 2008. And it even has a name. It's named after somebody. It's the Angelo Mozillo problem. Now, since this is not a US audience, I'm afraid many people don't know who Angelo Mozillo is. Angelo Mozillo was the CEO of Countrywide Bank. It was a large housing-focused bank in California in the run-up to the 2008 financial crisis. It made a lot of loans. It looked really great financially during the period from about 2005 to 2007. Mr. Mozillo, the CEO, was paid on an incentive basis. He got total executive comp during this period of over $400 million based on the wonderful performance of this institution, which, as soon as the housing market turned in late 2007, went very rapidly bankrupt. Mm-hmm. Right? His incentive structure was shorter than the economic cycle. Right? Now, he eventually got pursued by the Securities and Exchange Commission. He was unlucky in that because his bank had actually failed, he wasn't able to hold them off by saying that if you prosecuted me, then my bank will fail, because his bank had already failed. So he didn't have the defense that was available to the executives of Citigroup and other places that were able to get away with it. But Mozillo got actually prosecuted. He had to pay the vast sum of $60 million in fines to make up for what the enormous damage he did. Hundreds of thousands of people thrown out of their homes. I don't know if you guys can add and subtract or not, but 400 million minus 60 million is not zero. Mm-hmm. All right, so the point being that incentive structure worked just great for Angelo, even counting the prosecution, right? That he walked away with, I mean, I assume he hired very expensive lawyers. They must have cost him at least $40, $50 million, right? So his net take before taxes was something like $300 million. For the investors in Countrywide, the equity holders were completely wiped out, unless you played Angelo's game, unless you understood what the racket was. They were completely wiped out. The bondholders were haircut. The public had to eat a great deal of it, and as I said, several 100,000 families lost their homes, and millions more were negatively affected by the housing market impact. Right? That is a story about incentives and understanding how incentives are a form of wealth transfer. Now, these things are highly material. Right? They are, they were decisive if you made the mistake of investing pension fund assets in Countrywide. Right? And not just in Countrywide. The Mozillo, I call it the Angelo Mozillo story because it's so tangible, it's so easy to explain, you get it immediately. Essentially the same thing happened across not just the entire US banking system, but the entire world's banking system. The net losses were in the tens of trillions of dollars, right? And pension funds around the world were devastated. Right? These issues are about inequality, but they are also simply about risk and return and principal agent problems and incentive problems. They are the core of what money management is about, the core of what fiduciary duty is about. The punchline, and I'm going to stop here, is that the job of pension fiduciaries is not to fix inequality. When union members are on pension boards, that's not their job on the pension board. It's not the money manager's job. It's not my colleague Jason's job. It's not what we're hired to do in that role. The job is to ensure that the pension funds are funded, and the money's not stolen or misused or put at risk in ways that are irresponsible. That's the job. The reality, though, is that when you take that job and then connect it to corporate governance, corporate finance, and the larger macroeconomy of the world, and particularly on a large scale where you can't escape market efficiencies, right? You can't get that job done properly in a world of runaway inequality. Mm-hmm. Right? You can't do it. And there are duties that flow from that, in my view. So I'll stop there.